What's going on, guys? Welcome to today's video. Pretty simple video. I just want to go over how you can effectively hedge your bets or hedge against a second market downturn given these very volatile market conditions. It's no surprise, cases are rising. In my state of Florida, it's almost 10,000 cases a day. Texas, Arizona, California. Europe just said American residents can't, come to the EU. So it's not looking pretty good, but the stock market is still going up. As of right now, it's up 1.16%, which is pretty significant. You might be wondering, why is the stock market going up when cases are going up as well? And that's a very valid question, very valid thing to think about. What I have realized is that here's a quote, that the market could stay irrational longer than you could stay sane. And what it means is that sometimes you got to understand that there's multiple factors at play influencing the stock market and prices of individual stocks. What I kind of realized recently is that, and it's kind of obvious in hindsight, but if the stock market traded on the actual book values or intrinsic values of the companies and like the actual valuation and the worth of the companies, then there wouldn't be a stock market, because there would only be one price for each company and one price for each ETF. And it would be the correct price, the accurate price. And if that was the case, there would be no changes in price, right? Every stock would have one price, and if they had more profits that year, the price would rise, and so on and so forth. So the stock market it's not supposed to be 100% tethered and connected to reality in that sense. It's made up of people, and people are greedy and fearful and emotional and impulsive and all that. So the stock market, by extension, is going to be that too. That's what makes the stock market interesting and fun and kind of strategic, is that you have to kind of marry reality with uncertainty and contradiction and paradox. If you're like me and you're wondering why the stock market is going up with everything going on in the world, it's because there's a number of factors at play. There's stimulus bills, there are optimism of vaccines and of whether or not this is overblown, there is questions of how much of this is already priced in, and that sort of thing. So it might be easy to think on the surface level that this doesn't make sense, but if you look deeper, there's reasons to understand. On to the main part of the video. There's a few ways you can hedge your bets in today's market conditions. The first of which is just to take a bet against the stock market, or to take the opposite bet. So let's say as a dividend investor or a long-term investor, you're utilizing compounding interest, you're buying high quality dividend stocks, and the idea is over time you will see a return. There's some sort of there's an argument to be made that you should take some small percent of your portfolio dedicated to the downside of the stock market, to going short the market. You could buy a put on the market, meaning that's an option where if the stock market goes down you make money, or you could sell short certain companies or certain ETFs. The risk with doing so is that the room for loss or the room for error is infinite, because the stock market, there's no ceiling price. The stock market can go up and up and up forever, and with it your risk and your loss, your unrealized loss, can go up and up and up forever. On the other side, when you take a position long in this company, or you buy a stock, the most you could lose is just the amount you invested in, because the price goes down to zero and you just lose your investment. For transparency purposes, I do have positions both long and short, meaning if the stock market goes up, I will make some money, but also lose some money in a sense, because if the stock market goes down, I will make some money. But my net weighting is definitely towards the long side. So if the stock market does go up, that's kind of where I will make my money on net. The second way is through diversification, and you should have been doing this anyway, but the idea is you don't want to put all your eggs in one basket, because if you do, and it takes a hit, then all your money is gone pretty much, or your value goes down. But if you diversify, let's say one sector goes down but another sector goes up, on net you make money. That's the point of diversification. In these market conditions, certain sectors and certain industries and certain companies are just better positioned to survive this sort of current environment. And if you had exposure to those industries or those sectors or those companies and others, then you could have been well benefited during the crash. But this isn't some sort of strategy or theory that's only applicable to volatile conditions. It's what you should be doing anyway. You should never put all your eggs in one basket. You should always have diversification because you want broad exposure. The trade-off with diversification is that the more you diversify and the more you spread your money out, the less kind of insane or significant returns on one stock or on one sector you're going to see. On the flip side, you can see it as a benefit because you could view it as money saved is money earned. So rule number one of investing is not to lose money. So if you diversify heavily, then there's a lower chance that you lose a lot of money. The last way, and this is what I'm doing personally, is just to take money off the table and reduce your exposure to the market. This is pretty standard and pretty self-explanatory, but the less money you have in the stock market, the less room you have for both upside and downside. I currently have around like 20, 25, 30% of my investable assets in the market, and the idea is if the stock market goes up, well, I have upside because I have that exposure, but if the stock market goes down, I have the majority of my capital to invest and deploy to dollar cost average down and pick up very good quality stocks at a discount. The risk for that is that you lose money and there's an opportunity cost for holding your money in cash. What if the stock market never comes down? What if it just keeps going up? Well, then you miss out on that upside. So that's the risk. The benefit is that there's no really direct downside. The only downside there is the opportunity cost and the what if. That's it for today's video. I hope you enjoyed. If you did, leave it a like so the YouTube algorithm can do its thing. Comment down below what your thoughts are on the market and how you're positioning your investments and your portfolios. And if you're brand new, hit the subscribe button, join this channel. It's based on investing and personal wealth and honestly a road to financial independence. So if that interests you, hit the subscribe button. With that said, I will see you for another video sometime this week.